Hello, and thank you for joining me for my talk, Market Sizing for New Products. I'm Kevin Zentmeyer. I lead product marketing at Ibotta, and I've been a product marketer at 5 different companies now, so seen it done a few different ways. I have a BA in economics and an MBA in marketing analytics, and I used to work in finance, but now I work in product marketing, and it's a lot more fun. So the goals of this talk will be to demystify market sizing, to give you a playbook, and show you how to use it with a lot of examples. So the keys to market sizing are: one, finding some numbers, kind of a place to start. Fill in the blanks with assumptions. You're going to pick a method and then do a TAM, SAM, SOM. What is that? Well, we'll get into that in a little bit. First, got to find some numbers. So why is market sizing hard? It's because data is missing. You never have all the data that you want, and the data that you have doesn't apply perfectly to your situation because you have market data on a larger market, but you're really getting to a niche within it. Or you're getting into it in a unique way that's unique to your business, and therefore the market data doesn't perfectly apply. So there are 3 types of numbers. There's product data, market data. This is why product marketing comes in, right? There's a good overlap here. And then assumptions, which are really the made up data that you use to cover the gaps in information that you can't find out there. The first place you should start is by figuring out what type of opportunity it is. So you're going to launch a new product. What kind of product is it? Because that type of product will help you figure out what to do next. So there's really 4 types, and you determine what type it is based on: is it an existing product or new product? Is it an existing market that you're already in or a new market? Using this grid. So let's start with an easy one. So it's an existing market and an existing product. So in this case, it's just really an iteration of what you already have. So it might be a platform upgrade. You're moving from V1 to V2 of a product, something like that. These are typically the easiest because you already have a whole lot of information on what it is that you're getting into. You can still screw it up. As you can see, my example here is New Coke, one of the biggest failures of an iterated product ever in history. So you can still do it wrong, but in general, this is the easiest because you have the most information that's the most relevant to your specific situation and what you're doing. Then on the other end of the spectrum, you have new market, new product. So in this case, you have basically a new market entry or a startup, right? This is quite hard because in this case, you don't have any internal data on either. No information really that's specific to what you're doing. All you really have to rely on is third-party data, market information that's already that's out there, and again is going to be generalized and not specific to what you're doing. In this case, the iPhone is a good example as a new market entry. These are generally the boldest the boldest moves that have the most downside. You can very easily screw this up, which is why I've got it labeled there as hard. And then in between, you've got the 2 others. So in the bottom left quadrant, you have new product, existing market. So in this case, you call that a line extension. This is moderately difficult to size the opportunity. I've got cherry vanilla Coke there as my example. In this case, it's actually technically a line extension of a line extension because first you had Cherry Coke, which was a line extension of Coca-Cola. And then Cherry Coke did so well that they decided to do a line extension of their line extension and make Cherry Vanilla Coke. And in this case, basically they had such great data from their current customers, and knowing that of their large group of Cherry Coke buyers, that there were quite a few that would want a vanilla flavor, and that would basically bring additional incremental sales to them. So they decided to roll that out. This is moderately difficult because, again, you have an existing market, which is a little bit easier to gauge, and new product. So a little bit of both. On the other hand, you have market expansion. So here I'm using AliExpress as an example, which you may or may not be familiar with. You're probably very familiar with, or hope you're familiar with the parent company, which is Alibaba. So Alibaba is one of the largest e-commerce companies in the world, largest e-commerce company in China. But if you can't crack the United States or Europe, then you're always going to be limited in terms of your reach. So AliExpress is their market entry into the United States. So it's an existing product essentially, in that they're rolling out something like their Taobao marketplace that they have available in China, in the United States. So existing product, new market. So they have a lot of data on how their marketplaces have done in China, and they're deploying that in the new market, which in this case is the United States. So why do we do that? Well, we determine which quadrant they fit in because determining whether it's a new market or a new product, et cetera, will give you a great indicator of which numbers are going to be useful to you. So if it's a new market, you're going to need some market data. Statista is my source of choice. You can use whatever you want, but Statista is pretty cheap and generally has market on almost data on almost any market you could possibly fathom. So that's my go-to. If it's a new product, you're going to want product data that you don't have because you have not deployed a product, right? This is a new product to you. So competitor data is a good way to go. So these are basically products that are already live and in that market. And essentially you want to study their customers. So you can do this with financial reports, with doing actual consumers or customer studies, where you're asking people who are users of that, let's say B2B SaaS platform or users of that consumer service, how they feel about it. And then that will give you real feedback of a thing that already exists and will give you a good proxy for how your product will be received, that will be probably somewhat similar to the one that's already in the market. If it's an existing market that you're already in, great. You've got internal market data and that you have customers, right? You already have customers that you're selling to in that market. So ask them how they feel about whatever it is that you're doing and how they'd feel about this new market entrant that you're going to pull in. If it's an existing product, that works too. In that case, you have internal product data, your BI dashboards, right? So whether you're using Tableau or Looker or whatever, start digging into those and find out what you can find out about your product that you already have live. Whatever you know about it will be useful as you bring that into a new market or do an iteration of that. So let's sort of operationalize that or make it easier for you, and let's run through some examples here. So with market expansion, we've got AliExpress. So they're an existing product, essentially, entering a new market. So in that case, you've got external market data. You're going to want to, if you're the product marketing manager for AliExpress, you're going to want to dig into Statista and figure out what the stats look like for e-commerce in the United States. And then you're going to look at your internal product data in your BI dashboards to figure out what's going well with Taobao or whatever platform is most similar to AliExpress in China, and figure out how you can leverage those advantages in this new market and how they'll apply there. And then you're going to fill in the blanks with the assumptions. In the case of Align Extensions, this is, again, new product, existing market. So bolting onto what they've already accomplished with Cherry Coke and doing Cherry Vanilla Coke. In this case, you've already got customers of your Cherry Coke product. So ask them, how would you feel about a Cherry Vanilla product? You've got external product data. So in this case, competitors who already have some kind of vanilla cola product or vanilla other soda out there in the market. So figure out how those are performing, figure out how people feel about them. And then again, fill in the blank with assumptions. So an iteration, in this case, new Coke, right? So hopefully they asked their customers, how would you feel about a new version of Coke? I have a feeling they didn't. And then you should be looking at essentially your BI dashboard. So, how's Coca-Cola performing? Pretty well, right? You're already number one in the market. That's not bad. So I'll compare this to Domino's Pizza. So in this case, New Coke was a horrific failure. They lost a ton of money in marketing and supply chain by building this product that nobody wanted. I have a feeling it's because they did a terrible job of that bottom left portion there, which is internal market data, asking your customers, is this a thing that you actually want? Whereas Domino's Pizza did an incredible job. They had a product that was known for delivery, great at getting pizza to you quickly. However, they realized, call it 10 years ago, that their pizza was terrible. And they realized it because their customers told them it. Their customers said, hey, your pizza kind of sucks. And what did they do about it? They listened. So created a new pizza, a new version of their pizza, rolled it out, did a marketing campaign, and you can check out their stock price and see what it's done over the last 10 years. They're just about the top performing stock in the New York Stock Exchange. So again, listening to your customers, that bottom left one, the bottom left corner in that triangle, very important in this case. New market entry. So this is the iPhone. So in this case, you don't have a whole lot to go on because you're basically looking at statistics to figure out like what's the phone market look like, and then you're looking at external product data to say how's, in this case in 2006, 2007, how's BlackBerry doing, if you remember them, how's Motorola doing, and then making assumptions on how you're going to perform in that market. It's very risky. Obviously, in the iPhone's case, it paid off. But this is a very risky way to go. So we've got some numbers. Now we're going to fill in the missing numbers with assumptions. Well, how do we do that? Well, start with benchmarks. So a benchmark, or a good benchmark, is basically saying what is most similar to this, to the number that I'm missing. What's the most similar situation or number that I can look at? You can use internal benchmarks or external. And this really depends on what kind of situation you're in, but let's say that you're launching a new feature. What's the most similar feature that you've launched in the past, and how did that perform? What data do you have on that, for instance? Or this is a new product and you want to look at, well, what else is out there and how did that perform? What's the most similar product I can find, or most similar market? And then you're basically going to adjust up or down from there, from that benchmark. So ask yourself these basic questions. Are we better or worse? Is this product better or worse? As a company, are we better or worse than the benchmark? Is the environment more or less favorable? Is the competition a little tougher in the area that I'm looking at? Those types of things. And then the thing that you should then question is, again, because you're making assumptions, this is the riskiest point in the triangle. So you really need to focus on having good assumptions. So what underlying assumptions are sort of underlying my assumptions? So essentially, why is it better or worse? So if you have this benchmark and you're saying, hey, I think we're a little better than that. Why? Is that hubris? Am I making an assumption that that my company's going to perform better because I have a bias? Basically question your assumptions. Are you making any assumptions here that are sort of unrecognized, that are going to be dangerous, that you want to de-risk and sort of find other benchmarks beneath it to determine whether you should actually adjust up or down? Don't just sort of do it at random, like, well, I feel pretty good, so I'm going to say that we're going to do better than that. That's not a great assumption, right? Find your benchmark and then find reasons why you should say that you're going to perform a little better or a little worse. So the next step is determining what type of model are you going to do? Is it top down or is it bottom up? It's not actually that hard to figure out, I promise. So what is top down and what is bottom up? Well, top down is basically investment banking. This is what an investment banker will do. They'll say, how big is the pie? And what is this company's share of it? What do I think it's going to be? And then you sort of assume that everything's going to work out beneath that, because as an investment banker, you can't really get into the nitty-gritty operational details of the company, because that's not really what you're doing. You're looking at big scale opportunity. So bottom up is more of like a sales ops approach. So if you're a sales ops manager and you got asked, hey, we have this new product rolling out, how many units are we going to move? This is the way that they would likely go, which is basically asking, which customers am I going to sell it to and at what price? They're not taking anything for granted, and they're going from bottom up to say it's going to be these 11 customers who are going to buy it initially. I think that these 20 might eventually, and here you go. So bottom up, you're much more detailed, and you're sort of naming what's going to work as opposed to sort of assuming what's going to work. So there's pros and cons to each one. So if you're going top down, it's faster, it's simpler. The con is that it's less accurate, but that could be okay. So it's good for a low data situation. So in a lot of cases, you can't do a bottom up analysis. And so top down is the only way that you can go. So top-down is obviously going to be useful in those cases. It'll give you a quick answer. It's also great as a sanity check. So if you do a bottom-up analysis, doing top-down as an alternate method to say, like, are these numbers close? Because if they're really far apart when you do bottom-up and top-down, something's wrong, right? So doing top-down as an extra method can be really helpful. Top-down is very useful in new market entries because, again, you just don't have a lot of detailed data to go on. You're taking broad strokes of here's what the market looks like externally. Here's what the people who are already in it are performing. You don't really have a lot of other information because you're not in that market. You're not making those products. Bottom up, theoretically more accurate, but it's slower, it's more complex, which you as the product marketer who then have to do that sizing, that is a downside, right? That's gonna take your time up. It's good for scenarios that are very specific to your company, and it's especially good for an iterative launch, because if you think about bottom up, you have lots and lots of data, which is good for bottom up if you're on an existing market and an existing product. So in that case, you can get into your BI dashboards, find all the data you need. You can get into Salesforce. You can interview your customers. You can pretty much get everything you need to do a very accurate bottom-up analysis there. So what's not mentioned? Well, we've got new market entry covered with top-down. Bottom-up covers the iterative launch. So in between, you've got the new market entry and you've got the line extensions. In those cases, ideally, in my opinion, you want to do both and do that sanity check, because you'll do sort of a patchy job of doing bottom up, and so you'll want that sanity check. However, you have enough data that you don't have to just do a top down in that case. So again, probably do both if you're in one of those two in between quadrants. All right, so now I'm going to run through an example. We mentioned the iPhone earlier. Well, now we're the product marketing manager for the iPhone. So we're going to do a TAM, SAM, SOM. So I'll start with what the heck is a TAM? Well, a TAM is the total dollars available in the market space. So in this case, phones, right? We're getting into mobile phones as Apple. We're building the iPhone. It's 2007. Back in 2007, how fast is the market growing? It's growing at 16% a year. In that case, because it's growing so quickly, you probably don't want to just do a year one project. You don't want to just look at year one because years 2, 3, 4 are going to be significantly more valuable. So when you actually do the analysis, you're going to want to project out how big is that market, in years 2, 3, 4, 5. But if it's a pretty static market, you don't really need to do that. And in a TAM, you need to estimate what the share of those dollars that you reasonably think that you can capture. So in this case, are your customers switching from competitive brands to yours, or are you taking people who are new to market? Well, in this case, the market's growing by 16% per year, and as a new market entrant, you can probably get all the growth you need essentially from those new market entrants that are making up that 16% per year growth. So that makes it easier. So in terms of how aggressive you can make your forecast and how much share you think you can get, growth is good because it's easier to get people who are new to market to adopt you versus switch, right? If we just think about cell phones back in 2007, you were locking in 2-year contracts. So if I just bought a BlackBerry 6 months ago, I can't very easily go ahead and switch over to an iPhone without paying a whole bunch of money to AT&T to rip up my contract. So basically, new entrants are easier than switchers. The other factor to consider is who's my competition? Who am I competing against? Is it mom and pop or is it Walmart? Well, in this case, I'm competing with, since I'm the product marketing manager for iPhone, I'm competing with BlackBerry, Motorola, Ericsson, and you could say at the time, BlackBerry had pretty good security, but none of them were sort of blowing the doors off in terms of, the feature functionality that they're rolling out, and people didn't really love them outside of BlackBerry. BlackBerry had a lot of fans back then. So if we just say, how competitive it is, and do we think we can get share, we can make some assumptions. So we go to the bottom. There in 2006, about 1 billion units were moved. I didn't round much; it was pretty close. And the average selling price back then was $200 for a phone, quite a bit cheaper than today. And I think I'm Steve Jobs, so I'm going to think aggressively. I think that I can go get 20% market share. Phones are basically computers. We make great computers, certainly better ones than Ericsson does or Motorola. So I think we can get 20% in the long run eventually. So I think our total addressable market is $40 billion, 20% of that $200 billion total. All right, now let's do the SAM, the sellable addressable market. So a SAM is basically out of that total addressable market, what share of your customers does your current product meet their needs today? So yes, eventually I think that I can go get $40 billion in market share. Sorry for the typo there. It says 30, but I think I can get $40 billion eventually. But today, what feature needs do customers have? Well, they want email, they want maps, they want browser. I can kind of do those things. My iPhone will do that. But really what I'm pushing as what's special about the iPhone is apps, which is a brand new concept to the market. So I'm pretty much meeting the feature needs, but if you look at B, at what price point, right? So the average price point for a phone back then was $195 versus I'm rolling it out at $499. Super premium price point. That's going to have some serious trouble for market acceptance, and you're really just skimming or scraping the market from a pricing standpoint. So it's going to limit our market potential. So sellable addressable market is really where I think the product marketing magic comes in, because you're saying, what's the product market fit of my V1? So given the price point, I'd say the product market fit of my V1 limits my potential to, let's say, 10% of what the TAM was. So that $40 billion TAM times 10% equals 10% product market fit equals 4 billion. So my sellable addressable market, or in other words, how much of the market do I think I can get with this product that I have today, if everything went perfectly, would be $4 billion. So now the SOM, the SOM of the TAM, SAM, SOM. So basically, this is where we're going to answer these questions. You're assuming that you can go get $4 billion. Can you actually sell to these customers today? Can you service them? Can you physically reach them? When are these questions true? Basically, when do you think you can actually get the phone into these people's hands and physically sell it to them? So if we rewind back to June of 2007, when they released this product, they only released it through AT&T. That's a significant limiting factor. AT&T at the time had 35% of the mobile phone market. So therefore, if you take that $4 billion SAM and we say, well, AT&T is actually going to handle all of those questions above in this case. They are, as the mobile carrier, actually kind of doing everything, and I'm just shipping product to them. In a software sense, this might be more of a managed services approach, and having a channel sales team and another company that's handling all those things. If that's true, then you can basically say, how big is that company? What share of the market do they have? And that essentially covers your SOM, because you're not having to develop those capabilities internally and sort of ramp those up over time. You just say, hey, I'm using Cognizant, or I'm using whatever servicing company to handle this. So I can immediately say it's going to jump to this percentage of the market. So 35% penetration of AT&T times my 4 billion and SAM equals 1.4 billion. That's my SOM with a June release. So the only problem is that's halfway through the year, right? So with a June release, I've only got the back half of the year to sell through. So I take, in that case, my 1.4 billion after you've accounted for AT&T, and then say half the year's left. So therefore it's 0.7 billion is what my actual SOM is for H2 2007. So that's my forecast as the product marketing manager of the iPhone back in 2007. So actual sales, 694 million. Obviously, hindsight is 2020. I know this, and so I'm working backwards into the numbers, which certainly makes my job easier. But you can see how the math actually comes together into creating a good forecast for what actually occurs. So let's pull it all together. So TAM, SAM, SOM. The way that I think about this is start with a pie chart, and then it's a bar chart, and then a line graph. So to start with the pie chart, the TAM. So that's where you're really saying, hey, the mobile phone market is worth $200 billion. We think at some point in the future, that little pink section is us. We're going to own 20% of it. So you're saying the TAM basically is, this is what we can get someday with some product that we develop in the future. This is what I think we can get. The SAM is where you start to convert that into product management and product marketing language. So this is where you're saying, hey, with the V1, we can't get 40 billion, excuse me. I'm sorry, CEO, but that's not how it works. With the V1 of this product, the minimum viable product, I think that we can get 4 billion with the product that we have now. And then you're sort of stepping that up with the versions and features that you deploy later. Now, SOM is where you actually convert this into a financial forecast. This is where it's very useful to work with finance and your sales team, your support teams. Customer support's very important. So this is where you're actually converting it into a forecast and saying, all right, well, 2007, basically we're going to do 0.7 billion in H2 of 2007. So this is where you're saying, I'm going to get these versions rolled out at these times, and I'm going to have the sales and service elements ready in conjunction with that to be able to deliver sales of this nature. So this is where you've applied all the filters basically. So you're saying, this is how big the opportunity was. This is when we're going to have that product. And this is when we're actually going to be able to have sales and service to be able to do that and get that there. And this is really where the rubber meets the road. I think what often catches people and where they make some missteps is they start with the TAM and stop with the TAM. They only ever do the total addressable market analysis, and it's actually not that particularly useful. It's great for investor presentations with VCs, that type of thing, but it's not actually that useful in terms of what you actually make plans around as a company. What you really need to do as a product marketer or a product manager is you really need to dig into the weeds of the SAM and say, what versions are actually going to deliver on customer needs to be able to, and at what price point, to be able to actually make the sales happen for us to be able to capitalize on that market potential. And then the SOM, when can I actually say that we're going to hit this in the financial forecast? Because that's what the CEO actually really wants to hear at the end of the day. And so don't stop with the TAM. Keep carrying it all the way through. That's my takeaway. Please do the SAM and the SOM. So what did the iPhone do? Well, they did pretty well. So if you start in 2007, you say, all right, well, they did 0.7 billion revenue in that second half of the year. That was 0.3% market share of the cell phone market. Not too shabby, but nothing that really woke up the market at the time. That was 3% of Apple's revenue. So if you think about in the general sense of is that a successful product or not, that's sort of middling, right? That's sort of, you look at that as we're doing okay, but it's nothing special. But you can see the bar graph really take off. By 2018, they had 32% market share of the entire cell phone market, $218 billion in revenue. This is where iPhone really peaked as a share of Apple's business. It was 82% of all of Apple's revenue. So this obviously became a very important product. I think if you rewind back to 2006, 2007, it would not surprise me if somebody in Apple was doing the TAM analysis and saying, hey, phones is actually a really big space for us. And then we actually broke it down into the SAM and said, what can we do versus our competitors? It looked pretty attractive. And when they got into the SOM and said, hey, we could deploy this through AT&T and basically have market penetration immediately, they said, hey, this is an opportunity worth pursuing. You should take the same approach. Last section, ceteris paribus is for suckers. So let's start with what the heck is ceteris paribus. Ceteris paribus means with other conditions remaining the same. It's a concept from science. And why is ceteris paribus for suckers? Basically, it is something that you have to assume to start with to be able to do your analysis. Otherwise, you get lost in the details. However, You can't stop there. If you just assume that everything's going to remain the same after you launch your feature, you're naive, right? You know this. You have competitors. And so if you do something, they're going to respond. So it's important to do that last step of, let's just think through, if we roll this out, what are our competitors going to do? Excuse me. Let's do a little bit of game theory real quick. It's not scary. It's really easy. So if we assume ceteris paribus, we assume we have no competitors. We launch this product. It's unsuccessful, that top left quadrant. Well, that sucks for us, right? If you're successful, great, right? Very simple. Like if this works out like we're planning and like our math says when we're doing the pro forma up front, great. This is a great situation. And if it doesn't work out, that sucks. Let's add on the extra layer of the competitor response. So if it's unsuccessful, your competitors are going to let you fail all on your own, right? They're not going to match you. They're not going to do anything about it. They're just going to let you waste that money and they're fine with it. However, if you deploy a product, a new feature, et cetera, that is successful, if you're in a competitive market, your competitors aren't just going to sit there. They're probably going to do something about it. So that question mark is really what you have to answer because you're hoping that this is successful. Otherwise, you wouldn't launch it. So you need to think through, if it is successful, then what? Well, let's judge our competitors' responses. So you've got defensive competitive advantages. That's a moat. That's what Warren Buffett talks about. These are the things that they traditionally teach you in business school. That's if you have intellectual property, patents, that type of thing. You deploy a new thing, they can't follow you if you have a patent, right? They're gonna have to do it a different way. If you have brand recognition, you're the biggest brand in the space, you're Microsoft, that's relatively gonna scare people off from whatever you just did to some extent. If you have large scale, again, Microsoft. If you're a Microsoft, yeah, you're kind of scary, right? People are not so interested in following you. If there are regulatory barriers to entry, let's say you're in the market of selling to governments, you're Microsoft again, and you just won a massive defense contract. That's tough for competitors to follow. You're recognizing a theme here probably. If you have a technical barrier to entry, so you've done something that is very hard for somebody else to replicate, then that can help you as well. Versus if you were just taking off the shelf, off the shelf software, bolting it together and throwing it out there into the market. That's not that hard to follow. Offensive competitive advantages, that's something that gets talked about a little bit less. So is there a technical advantage you have here? So this is a thing that's hard in general. It's a hard space to do, like AI. That can be a huge advantage to you. Pace of further innovation. So let's say that you develop voice recognition, and then you press your advantage, right? So you decide, I have this new feature, but I'm not going to stop there. If you don't stop there, it is harder for other people to keep up because you already have the lead. So if you keep developing on top of it, it's going to be very hard. People are going to have a very hard time catching up with you, even if they do have more resources, because typically you have to build on top of things that already exist. Brand focus. This is a more interesting area. Let's again compare with Microsoft. Microsoft is sort of everything. They do all kinds of software and try to be everything to everyone to some extent. So if you are a very specialized player, you build this new market entrant that just does this specific thing, then you can build your entire brand around it, which gives you quite a bit of credibility that an IBM or another company that's very large can't necessarily replicate, because you look like an expert in the space just by focusing your product and your brand around that one thing. So that can be an offensive competitive advantage as well. So what's the point? What's the point of the stuff that I just went through with ceteris paribus? Well, some market sizes come with an asterisk. So if basically you don't know what's going to happen after you release it, then it comes with some risk, right? And so your big scary competitor, let's say Microsoft, may copy you. And so when you say that, hey, in year 3, I think we're going to make $10 billion, you do need to apply some risk to that, or a question mark to say, but somebody could follow us into this market, and our new position is not that defensible. So you should prefer positive or non-existent competitive responses. Um, so a non-existent competitive response would be they leave your new business alone. So you roll out this new feature, your competitor doesn't copy you. That's great if they don't. An even better response would be a positive competitive response, which is they leave you alone entirely. So let's say this is the case where you are very specialized and you've built a competitive advantage within a narrow category. If you press your advantage and keep building additional features that push you in a certain direction, what can happen is a competitor just says, you know what, screw it. They've built the best business analytics software for hospitals that ever existed, never will. And you know what? It's just not worth it for me to pursue it anymore because they've built so much specialized stuff in that area that I'm just abandoning it. That is the best case scenario. So not only can you have a case where, let's say that your forecast is, hey, I think that we'll have this space is worth $10 billion to us. That's great. But if in actuality, you building that out not only brings in new revenue, but scares off competitors, that's even better. So, so I think you want to carry this all the way through to just have basically that stuff in the summary or conclusion of your business case that you write, saying that you should roll out this new feature functionality that says, hey, here's some strategic considerations. Make yourself look really smart and say, here's what's going to happen, we think, in the competitive space because we rolled this out. So in conclusion, again, the keys to market sizing are go find yourself some numbers. You got to start there. Fill in the blanks with assumptions because the data is going to be imperfect. Pick a method. Go top down or bottom up. Depends on the situation. Depends on what type of opportunity it is, which we went through. And then do a TAM, SAM, SOM. Take it all the way through. Don't just do a TAM, please. Do a SAM and do a SOM as well. And remember, don't be a sucker. Don't assume everything will remain the same after you roll this thing out. Ceteris paribus is a fallacy. Your competitors will respond if you're successful. If you're unsuccessful, they'll let you fail on your own. Awesome. Well, if you want to find more content from me, you can find me at kevinzentmeyer.com. Thanks for your time.